Today, we're going to talk about the world's unluckiest investor. I mean, this is a guy who, by all rights, should have lost every penny he ever put into the market. His story goes straight to the heart of one of the biggest fears in all of finance. That feeling, that absolute terror of buying stocks at the exact wrong moment, right before a crash. It's a fear that keeps so many of us on the sidelines, just waiting for a perfect entry point that never seems to arrive. So let's just ask the question outright. Could someone with the absolute worst timing you can possibly imagine, someone who only buys at the very peak right before a massive market crash, could that person actually wind up a millionaire? I mean, it sounds completely impossible, doesn't it? Well, allow me to introduce you to Bob. In this fascinating case study, he's our unluckiest investor. And spoiler alert, when he retired, he was a millionaire. So let's dig into exactly how this happened, because I guarantee it's going to change the way you think about investing. Now, Bob's story isn't just some feel-good anecdote. Nope. It's a really powerful case study that puts our biggest fear, buying at the absolute top, up against decades of cold, hard data. Let's watch how his monumentally bad timing actually played out. So, here's the scenario. Over 40 years, Bob is a diligent saver. He puts his money aside, but he's nervous. So nervous that he only works up the courage to invest a big chunk of cash at 4 very specific and absolutely disastrous moments. In 72, just before the market got cut in half. In 87, just 2 months before the infamous Black Monday crash. In 99, at the literal peak of the dot-com bubble. And to top it all off, in 2007, right on the doorstep of the global financial crisis. His timing wasn't just bad, it was catastrophically awful. So you can imagine every single time he invested, his portfolio got immediately crushed on paper. He must have felt sick, just horrified. But Bob had one simple, incredibly powerful rule that ended up saving him. No matter how bad it looked, no matter how much his stomach was churning, he never ever panic sold. He just held on. So after 40 years of this gut-wrenching cycle of investing and then immediately watching things plummet, having put in a total of $184,000 over the years, Bob retired, his final net worth, over $1.1 million. Let that sink in. The world's worst market timer became a millionaire. The sheer force of just being in the market completely overwhelmed the disaster of his timing. Okay, I know what you're thinking. Sure, Bob did well, but man, he must have left a ton of money on the table. And you're not wrong. But to really get the big lesson here, we need to see how Bob stacks up against 3 other investors. And this is where the story gets really juicy. All right, meet the contenders. First up, of course, is Bob, our terrible timer. Then we've got Lucy. She's got a magic crystal ball and is a perfect timer, buying only at the absolute bottom of every crash. Next is Susan, our consistent investor. She just puts money in automatically every year, totally ignoring all the drama. And finally, there's Dave. Poor Dave is the cautious waiter, so scared of a crash that he keeps all of his money in cash, always. You see, most people get hung up on the difference between Bob's bad timing and Lucy's perfect timing. But this comparison is about to show us that the biggest mistake you can make in your financial life, well, it's not what you think it is. Let's see the results. So Lucy, our perfect timer, she ended up with about $1.5 million. Pretty great. And Susan, who just invested consistently, wasn't far behind with $1.3 million. And even our guy Bob, the worst timer ever, cleared $1.1 million. But then, look at Dave, the guy who stayed in cash. He ended up with just a fraction of that, around $400,000. Now, just look at where the biggest jump in wealth happens. And this, right here, is the punchline of the whole thing. The difference between being a terrible investor like Bob and a perfect one like Lucy, it was about 400 grand. But the difference between staying on the sidelines like Dave versus just being a terrible but invested person like Bob, that was a whopping $700,000. The biggest financial mistake isn't when you invest, it's if you invest. Getting off the sidelines and into the game is what matters most. Okay, but I get the temptation. You're thinking, I can be smarter than Bob. I can just dodge the bad days and buy the dips, right? The dream is to sell high and buy low. It sounds so simple. But the data shows this is an incredibly dangerous game to even try to play. Here's the trap. The market's absolute best days and its absolute worst days, they're like roommates. They almost always show up together, clustered during those really volatile, scary times. So if you sell out of the market to avoid a crash on a Monday, you are almost guaranteed to be sitting in cash and completely miss the massive rebound on Tuesday. And the cost of being wrong is just staggering. Take a look at this. Over a 20-year stretch, if you just stayed fully invested, you would have earned nearly 12% a year. But if you missed just the 10 best trading days, that's just 10 days out of more than 5,000, your return gets slashed. Miss the 50 best days, and your return is basically wiped out. Almost all of the market's long-term gains come from a tiny handful of explosive, unpredictable days. So, if trying to be a market timing genius is a fool's errand, what's the actual strategy for success? Well, I like to call it the automated apathy protocol. It's all about setting up a system that makes you, for the most part, totally indifferent to the daily chaos of the market. And the protocol is dead simple. Step 1, maximize your time in the market, not timing it. The sooner you start, the more time your money has to grow. Step 2, automate everything. Set up your 401k or automatic transfers so the money gets invested without you even thinking about it. This removes fear and greed from the picture. And third, and maybe most importantly, be like Bob. Be stubborn. Once your money is in, the most profitable move you can make is usually no move at all. But let's tackle a common question. What if you have a big pile of cash right now, maybe from selling a house or an inheritance? It feels so risky to throw it all into the market at once, especially if stocks feel high. Shouldn't you just drip it in slowly? Well, Vanguard actually studied this exact problem, and what they found was that investing the lump sum all at once, just getting it over with, beat dollar cost averaging or phasing it in about 2/3 of the time. Why? Simple. Markets tend to go up more often than they go down. But, and this is a big but, psychology is king. If investing it all at once is going to make you lose sleep and panic sell at the first sign of trouble, then it is the wrong move for you. Phasing it in is like buying insurance against your own emotions. It's not the best strategy mathematically, but it might be the best strategy behaviorally if it keeps you in the game. At the end of the day, it really all boils down to this one simple metaphor. The stock market is a roller coaster. It has terrifying drops and thrilling climbs. But the only people who really get hurt on a roller coaster are the ones who try to jump off in the middle of the ride. You have to stay in your seat to get to the destination. So the ultimate lesson from Bob's incredible story is this. You don't need a crystal ball. You don't need perfect timing. You don't even have to be a particularly good investor to build serious wealth. You just need to get in the game, stay in your seat, and most importantly, you just need to not be Dave. Thanks for tuning in.